Welcome, Blockhead traders. I must inform you that here at Blockhead Traders, we are not financial advisors. Nothing we say should be considered financial advice. At Blockhead Traders, we aim to share our own thoughts and opinions on financial topics. We do this so that you will have other viewpoints and references to use to make your own financial decisions. Today is Sunday, March 14th, 2021, and this is Blockhead Traders Weekly. In this episode, we'll be looking back at the past trading week and look ahead to the week ahead. And then we're going to discuss a topic of a poor man's covered call, which is a little enhancement from last week's episode about a covered call. And this week, I'm actually joined by another Blockhead trader, Mike Block.
Hello.
Hey, Mike.
That's me.
So as we get jumping in here, I wanted to put a plug out there for the Discord channel here at the beginning. Discord channel is something that's open to everybody. You can find a link of it down in the description. I hang out in there most days and evenings. Always looking forward to chatting about trading with any incoming people in there. It's a place where you can go and chat with other traders, get strategies, ask questions. It's a real low-key, casual environment. So check out the link in the description below and join us in the Discord. So as every week, we kind of start by taking a look back at the week previous and some of the action that's happened in the past week. So the first thing I want to jump to is some of the charts. And I kind of follow the markets with the S&P and the NASDAQ charts. So let me go ahead and pull those up and just give a little bit of a comment on some of what I'm seeing there. So this first chart that you see right here, this is something I kind of watch for volatility. What this is actually charting here is the VIX, the front month VIX over the 3-month VIX. So it's a ratio here. And it's basically reporting out the volatility of the VIX divided by the volatility of the VIX that's 3 months out. And what we kind of like to see is a lot of, it's called contango, where basically the front month volatility is lower than the back month volatility. And that's a pretty normal thing in the market. And so anytime this chart is under 1, you're basically in a contango situation. And when the volatility actually rises on the near term, so when the VIX is actually trading higher now than the 3-month VIX, you'll actually spike above 1 depending on what that imbalance is. And that's actually called backwardation. And that's usually a red flag that I kind of watch to for rough waters ahead or rough sledding. And you can see before this past week, basically the week before when we were having a lot of down days and everything, you can see that contango is really climbing up towards a 1. But in this past week, a lot of the indexes started to stabilize and kind of ran up overall in the week. Super volatile trading. So the candles and everything on the S&P were really tall. The candles in the NASDAQ were really tall. So I want to pull that chart up here. Yeah, so right here you can see this is the March 8th right here. You can see how much bigger, well, the candles were big here as the week prior to as we were kind of coming down. But for the week of March 8th, largely we were up on the week, which was great for a lot of my positions to kind of come back a little bit. And what I'm really looking for here in the upcoming weeks is more stabilization of the volatility. So I'm not looking for as massive swings in the price. Probably looking for the S&P to maybe stabilize into horizontal, maybe start climbing a little bit higher, but I'm pretty bearish on the NASDAQ. I think the time for tech is kind of coming to a close. And you can see that you kind of switched into a little bearish trend, and the 21-day moving average is starting to be resistance. And it was deflected off of that 21-day moving average again on Friday. So that was really what I was seeing in the markets this past week. The CPI numbers came out on Wednesday. That's the Consumer Price Index. And basically the week prior to last week, there was a lot of inflation fears that was really driving a lot of rotation out of tech and really driving a lot of the indexes down. And the CPI number that came out on Wednesday was largely in line with expectations. If not, it was a little bit softer. And I think that really kind of eased some of the inflation fears temporarily. But the stimulus bill passed in Congress. The president signed it into law. That was fueling a lot of the inflation fears as well, kind of the unknown. What was that bill going to look like? What was going to be in there? How much spending was going to be in there? So I'm really kind of expecting a lot of that to kind of play out this week and kind of stabilize as all that gets priced into the market. As I want to talk about a couple of the trades that I put on. But before I do, I actually want to call your attention to something that I do. And in the Discord, we have it posted in the Discord, but actually every trade that I make, I publish on Theta Gang. So you can find all of my trades on thetagang.com/sprocket888. I wanted to call that out because you can, my trades are open books. You can see what I won. You can see what I lost. In all the trades, you can actually, I have opening notes that I add to the trades. When I close them, I put closing notes. I usually enter them the day that I put the trades on. The platform at Theta Gang doesn't actually let you go back and backlog trades. So, what you see here is my performance. I started doing this publicly towards the end of December of 2020, as I wanted to build up, credibility and honesty with the viewers. Just say, hey, these are the trades I make. This is how they worked out. This is what I was thinking when I opened them. This is what I was thinking when they closed. So one of the trades that I was going to call out this week was Rocket, and I'll kind of save getting into Rocket because the trade that I put on in Rocket was actually a poor man's covered call, and that's kind of the main topic for this week. So I'll save a lot of that till we get down to that section. So Ride is an EV company for Lordstown Motors, and they caught my attention on Friday because Hindenburg put out a report basically saying the stock is a farce. It's phony. It's cooking the books. It's essentially a very similar report that they put out to Nikola, a while back. And when I look at the chart on Ride, which is what caught my attention, normally I don't hop onto these things. I kind of let them play out a little bit. But this is the chart on Ride. And you can see back here, in August, in the summertime of 20, there was basically about a $10 level to Ride out here. And then it really started picking up steam, up, down, and it's really been falling off before the 16% drop on Friday. And the reason I took this trade is because when I looked at how far it goes to get to $10 versus the premium on this, because the volatility, I don't remember the exact numbers, but volatility was like 150%, 140%. It was really, really high.
Yeah,
okay. 140. Like it just screamed premium that just needed to be sold. So we'll find out if I'm going to regret this later on. But when I looked at the P&L, let me hop back to so this is my P&L on my Ride trade. Basically my break even is around $11, which isn't that far above 10. So worst case scenario, and whenever you enter a trade, I always recommend having an exit plan, multiple exit plans for that matter. But I always try to look and say, what's the worst thing that can happen? And for me, the worst thing is this thing starts taking a nosedive. And if it really takes a nosedive and enters around here at the break even around 11, that's still an okay place for me to roll this position further out in time to give myself a little bit more room, but I still should be able to collect good premium around that. And I usually set a bailout price as well. So I look at, okay, how much am I willing to lose on this overall position versus the premium that I took in? And my bailout price, which is usually about twice the premium that I collect. So in this case, I collected $600 in premium, and this is about a $1,200 loss. So that's usually my bailout price is $8. And I just feel real comfortable that $8 being, a good bit below this strong support line back here. I felt real comfortable taking this trade, and I probably can roll it for a bit if it goes against me. But I'm kind of expecting at least a rally back up to, maybe the 21-day moving average or 50-day moving average, which is around 19 and maybe 22, I think, are those two averages.
So I feel like if you go back to the chart, this is a situation that really speaks to the strength of price action and selling premium. That, I mean, this thing is getting just nerfed and tanked by Heisenberg, but you can see, like you said, that strong level, that $10 level. And so this is kind of where, news comes out. This isn't a stock somebody's going to want to necessarily touch unless they're shorting it. But at the same time, levels are obeyed, and such major levels, like you see three times that it kind of kisses this level, and finds very strong support there. So, this is, to me, one of those situations where selling premium makes sense, because you grab the premium. Now it's a waiting game. And history has shown twice that it knows how to bounce off this. And
yeah,
like
for sure,
you have options.
The only other thing that I did look at was I did pull up the Nikola chart, because Heisenberg also kind of smacked around Nikola. Man, that was, I don't know how many months ago it was, but I was in those trades too back then. But if you look at this chart for Nikola, you can see it got smacked around, but it really, this $12 level back here, $12 level, it really held up, and this thing's still trading around 17. So yeah, I mean, Hindenburg's probably got some bad news. There's probably some rough times ahead for the stock, but I just don't see him sinking this stock totally. So
yeah,
those are the things that I was looking at this particular week. I don't know about you, Mike. What do you have cooking this past week?
So one thing everyone should know about me is I don't watch the markets at large, like the VIX or, any of the high level indexes. So a couple things that I was watching. One was a confirmation situation that I had on a play that I have going on. I'm gonna just dive into some of the charts. Fiserv is a thing I like right now. This one I'm just holding stock on. But basically Fiserv is a transaction banking company. They sell transactions with banks and other members of the financial industry. So a couple of things I really like about it are, from a fundamental perspective, that, like you said, stimulus checks in, recovery, months, towards the end of this year, as we start to get back, through the pandemic, and people are spending more money, those things are going to happen, to the benefit of a company like Fiserv. And so what I saw, was obviously a climb up here, and then a little softening here towards the end of 2020, and then into 2021 we came down, but then we hit this support here at this, I believe on my charts, this is an annual level. So got some pretty strong support there, tested this 118, and then cleared it. And so then that's kind of where I jumped in, was clearing that. So I had just been watching that this past week. I'm not normally much of an investor mindset anymore, but this is one that I'm going to hold out, due to the upside of the environment on it. Kind of like you said, well, because of you, I jumped on some of the ride as well. Because again, looking at that chart, seeing that level hit, and the premium that was there, that, the chart would show that, like you said, everything is a gamble. Everything, this whole thing is a game of odds. But the odds are in the favor of the level holding, that level being at least the $10 level. I think 1250 is a very strong level. So jumped on that one about the same time you did. Feeling pretty good about, this thing isn't going to like go back to $30 or anything, but selling premium, I just needed to hold, and get the theta decay out of it. Then the other thing that I'm looking at is Sesson Bio. This is a more speculative portion of my portfolio. And kind of what's going on here is Sesson Bio is developing a bladder cancer treatment drug. And looking at the chart, there's just, from down here around, 40 cents to 50 cents, there's this strong uptrend. You get a surge, you get a leveling, you get a surge, you get a leveling. And then it just went wild. And when it went wild, this was on news that the FDA had accepted the application for the drug, and the FDA, after reviewing, had also approved the priority processing of the application for this bladder cancer treatment drug. So that's not normal to get a priority from the FDA, and I believe August was sort of a timeline for when official FDA approval would be on the table. So we got this big pump up, and then it's kind of cooled off again. It's holding its pattern here, and we hit this again. I think this is a monthly that it hit, and then we just cleared an annual level, but it's seems to be coming alive. Strong on the uptrend. So this is one thing that I was obviously watching last week for the last few weeks as it's cooled off. But I'm also watching on this upcoming week because there was, I believe, an announcement that there will be some news on Tuesday. I don't think it's going to be anything super crazy or anything, but I honestly forget exactly what it was. But in this environment with something like this, news is going to do something, so this is one that I'm trying, I'm certainly long on it and bullish on it, but I also want to capitalize on this clear wave pattern. So depending on what happens with whatever news comes out, I may take some profits and then wait for the next cooling, reload, and go again, especially if I have until August to wait for the big news. But we'll see how things start get priced in between now and then. But that's I guess that makes it look like I'm a very speculative person, but that's what's mostly on my radar right now.
Yeah, I think I gave a spoiler alert in there a little bit earlier in my section, but I'm not looking for a lot of new trades this week. Really just looking for a lot of my theta to burn off. And then I'm also looking for the earnings on Ride. So we put that trade in on Friday on Ride, and basically they got an earnings coming out on Tuesday after the bell. So kind of just waiting to see what that's going to play out and show. See if we're going to bounce and they'll put this Hindenburg thing to rest, or at least call it off a little bit with some factual data, because this will be the first time I believe that they've reported earnings since they went public. So that'll be a pretty big event that I'll be watching. I'm not too worried about my positions because I got a lot of time left on them. And like we already talked about, the levels, so I would be kind of looking for a nice pop up and a volatility contraction to maybe cash out of that premium that I have in Ride.
Yeah. I guess the other thing I'm curious to watch is tech, because obviously it took a shellacking. But again, now with the stimulus checks and then into the summer, so we're talking summer and then into the fall recovery period. It'll be. I'm curious when that's going to happen, but that's clearly going to come back. And so I think there was a lot on sale. With that shellacking.
I'd be real picky on your tech names though. Just because so many of those tech stocks have just flown so high for so long. When you look at the broad market, you look at some of the sectors and consumer discretionary and energy and banks and financials, and they really haven't fully recovered from the giant drop about a year ago. And tech has gotten all that drop back and then some. I'd be real careful with tech, with people fleeing out of tech, taking their profits, because as things start to reopen, a lot of these reopening plays, travel stocks, bank stocks, energy stocks, I think a lot of those things you're going to start seeing creeping up throughout 21. And tech's not, it's not tanking by any stretch of the imagination, but I'd be more anticipating a more horizontal trade across tech. That about wraps up last week, this week, look forward. So let's hop into our topic of this week of poor man's covered call. Actually, before we hop into the poor man's covered call, I just wanted to reiterate a couple of points from last week's covered call, just to kind of refresh your memory on a covered call and maybe get your viewpoint on a covered call, Mike, since you didn't join us last week. But let me pull up here a P&L of Microsoft. So basically, to remind you what a covered call is when you actually have shares of a particular stock, you can sell a call against those shares such that basically you're using your shares as collateral to sell the call. And what I mean is, so on this P&L graph here, if I was to just look at selling a call in Microsoft for the May expiration, I picked a 30 delta strike just because it's, high probability of success. But what you'll run into is you run into this infinite loss. Okay. So, if Microsoft just goes off to the races up and up and up and up, there's basically no limit on how much money you can lose if it runs past your strikes here. And as you kind of get deeper and deeper and deeper into the money out here, the margin requirements are just going to kind of go up and up and up and up. And so I really never advise selling naked calls on any equity because these things can jump even when you don't think they can, and you can find yourself in a world of hurt. But the nice thing, sometimes, these things have real good premium on the call side with a lot of call skew because you got people buying speculative calls and things like that. And you want to cash in on that premium, but you kind of don't want all that risk of the infinite loss. And that's where the covered call comes in. If you happen to have the stock, basically you just cap your gain at your strike price. So you can see that if I actually had 100 shares of Microsoft, I can use those shares to sell a call. And then if Microsoft goes off to the races, I'm fine. This thing is just going to bring me in $2,500 profit no matter how high it goes. You still have the same downside risk as you would have had if you didn't sell the premium. But basically selling that premium allows you to, if it doesn't run all the way up to your strike price, that's just money in your pocket. And you can sell another call at a future date as soon as this one expires or whenever you close it out. And what that does is it lets you keep pushing down your cost basis. So, if I pick this thing up for $575 and I get and it expires worthless, basically my new cost basis here is, about $224.50. Now all of a sudden I've got a lower cost basis on my shares. So it's a great strategy to kind of just milk premium out of there. And, if shares get called away from you, it's not a bad thing. I mean, you're still pulling in $2,500 profit. So that's the covered call refresher there. Mike, I don't know. I think covered call is one of the trades that I finally hooked you into your first premium selling on a covered call.
Yeah. And yeah, I mean, I believe that was the hook to get in because it's so low risk, obviously. I mean, especially on a position where if I'm going to set a limit, sell anyways, like set it with some cash to get the premium of the covered call. If it hits, it hits. I would have sold anyways. Now I have that premium. So yeah, it was definitely the entry point into options. It's also a huge vehicle for a multi-dimensional strategy. So I certainly use it now a lot, and I use it in ways that just make me more comfortable. So I may or may not have gotten tied up in the meme stocks, or I guess this is the episode where I just sound super speculative and just wild. But I was careful about which one so I picked Nokia, and bought too high. But it's still a good level for where the company's headed. So even though it was wrapped up in all of the meme trading and whatnot, I did not, jump big into GameStop or AMC, because those are fairly, well, we'll see about GameStop, because they do have an opportunity to be relevant again. But AMC, that's a struggle, unless they do something with all the money that they made from the stock, being able to clear, I don't know what, 250 million, or no, 800, 750 million, something off the books. So maybe that gave him some life. But so anyways, I bought Nokia too high, but it is a comfortable level for where the company's going. And then therefore, I did not set a stop loss on it, because because I knew I had this covered call in my back pocket, and it did drop more than I was comfortable. Maybe some 30 or 40% from where I got in. But this is also why you don't speculatively trade with a large portion of your account. So, this was a portion of my account dedicated to this activity anyways. So, now I'm in a position where I wait for some of the volatility to be there, because you want to juice the premium just a little bit. So anytime there's a nice little run, I'll sell a contract or two, as a covered call. I still try to keep, at least this point, because I'm so underwater, I try to keep that covered call pretty out of reach. I try not to, I'm just going to keep chipping, so, $50 here, $70 there. And then, just over time, like I said, the whole getting into this was, being a very solid company in a very, prosperous scenario with any trade issues or things with Huawei that are going on with 5G, that Nokia is there to kind of fill that gap. So long term, it's fine. So yeah, I just keep utilizing the covered call as a vehicle to, while I'm here, I'll just keep chipping away. And maybe if one of them triggers, okay, that's fine. But like I said, I try to keep the covered calls just out of reach, so I can close them.
So when you say just out of reach, basically you do you keep the calls that you're selling above your break even on the stock, or where do you set that at?
Well, so because I'm so underwater at 30, 40%, I can't even really get to my break even with a meaningful premium. So when I say out of reach, I'm looking at the chart, looking at the levels, and trying to stay more than the normal range above, just so that way, even if it runs, it'll it'll react at a level, and I can react accordingly. And then also, I try not to sell the whole batch, all at once. That I want to, because I have to stagger this, so that way, if one does trigger, oops, but it doesn't, leave me completely out on the position. But I don't know if that's a normal scenario, because it's climbing out of a pretty deep hole. But like I said, it's a hole that I'm confident in coming out of, just holding the shares.
Yeah.
So
yeah.
Just trying
no,
to
I've been in a position too where I was selling calls that were basically still underneath my break even, because I was so far down on it. And it's not a strategy I recommend any beginner to start with, because you can find yourself booking a loss. You think you're like, oh yeah, I'm getting premium, this is awesome. And you set your strikes a little bit too close to the money, and you get your shares called away at a loss. So I always try, if you're going for the covered call, try always to sell strikes above your break even or your cost basis on your underlying. But yeah, it's definitely not always possible.
Yeah, definitely. Yeah, certainly in a much more normal scenario where you buy shares, like say you have a position or an underlying that you like at $60 or something, and you buy 100 shares. Uh, in a normal scenario where you're not using this to help, where you're so buried, like so buy at 60. If you want to sell at 70, if that's your goal for that trade, then look at the premiums, and especially if you can be a couple weeks out and it's running up, and so you're squishing that premium, then put that order in, and then just let it go. And if it runs past, I mean, like I said, that's more of I would think more normal, where you're using it instead of a limit, sell, limit order. That I've had a couple of those. That just feels really good because you were going to sell anyways. So, especially when it's, I don't know, 3 or 4% off of where you were going to sell anyways, the premium can get really rich. And so then you kind of get double dipped on it.
But sometimes you might not have shares in the stock. And that's going to bring us to this new strategy that I want to introduce this week. It's a poor man's covered call. So let's talk about a poor man's covered call. And the reason this one came up in this week's episode was because this week, one of the traders in our Discord room, Kale146, basically brought the attention of Rocket to me. And I'd seen Rocket in the news as one of those kind of meme stocks out there. And, they were asking me about my opinion on Rocket, if I was going to trade it and, what I thought. And I started looking at it and I said, this one actually looks like this might be a good strategy to play a poor man's covered call. So let's talk a little bit about the poor man's covered call here. Basically, a poor man's covered call is when you don't own shares of a particular stock, but instead you buy an option on the stock, which is a synthetically long the stock. So what you'll do is you'll buy a call for the stock at some distance in the future, maybe 6 months, 6 to 8 months out. And then you're going to sell a call on the near term. And let me show you what I was looking at that really caught my attention on this one. So this is the option premium for Rocket. And if you look at April, it's come down a bit in volatility. It's about 113%. I think when I opened this was around 125%. So the premium is super rich here for this call. But there's that situation, whereas if I just sold the call to collect that premium, if this thing shoots up past, the $30 strike that I sold here, then you're looking at a world of hurt. And if you look at the chart, let me just pop up the chart here real quick. Rocket going to 30 is probably not beyond the stretch of the imagination here. So I really wanted that premium of, the calls, but I really don't want the risk of this thing shooting up to 40, 45, where basically I'd be down $1,200, $1,300 if I took that trade. So if you look back at the option chain here, one thing that I noticed was out here in September, which is, quite a ways out, 180 some days out, the volatility is only about 80%. And one of the things about theta decay is theta stays relatively constant up until about 45 days to expiration. It declines a little bit, but for the most part, it's kind of an exponential drop off as you approach the 45-day mark. It's just why when we sell premium, we always target, 35 to 45 days to expiration, because that's really when the theta decay starts to kick in. And so what I'm doing here is I'm buying an option out here in September. And I buy this option in the money. So I'm kind of long those shares, but that costs money. And then I sell the short option, which is actually picking up a little bit more premium. It has more extrinsic value because the volatility here is 113%, and it keeps me from, that upside risk is kind of muted. So what this looks like is when I have both of these plays on, you can see my P&L graph. If this thing were to shoot to say $45, I'm still going to pick up, $3,800. And the reason for that is because as this gets higher and higher, my near-term call that I sold loses money, but my long-term call that I bought just gets more and more and more in the money. And the real benefit here is the capital utilization. So in this particular trade, now I did 10 shares. I'd have to go back and look at my fill price. It's right here, $6. Yeah, so basically this was $6,000 to buy these 10 calls, but then I picked up $2,000 by selling the short-term calls. And, if I don't run all the way up here and they expire, I'll just sell another set of those and collect more premium, and kind of just rinse and repeat. But the key thing here is basically I got $4,000, say, tied up in this trade. But if I was to actually sell the covered call, and I would need 1,000 shares to do the same thing without, I'm going to take the long call off here. So now I just have my short call of 10 contracts and long the stock 10,000. You can see the margin that I would need is about $12,500 to get the equivalent thing in a covered call situation. So what you got here is much more efficient capital utilization. This has the same risk as kind of a covered call, but your margin that you take, your buying power hit, is much, much less.
So basically between now and September, you're basically just trying to work the premium of the environment to work back whatever you paid.
Yeah, exactly.
Call.
So as each of these days kind of go by, if this thing kind of crawls up here, maybe gets to about $29, maybe $25, maybe it doesn't go anywhere, and it just stays right here. Basically, I'm going to pull in that $2,000 on that call that I sold. And so once that short call is done, which it'll be done by April at the latest, because that's when it expires, as long as this thing doesn't really breach that strike price to the point where the shares could get called away, because if the shares get called away from me, then basically I will exercise my long call to cover it. And that's why this P&L is up here. If I have to exercise that long call, that's really where I'm going to pull in the $4,000, $5,000 on a giant run. But my setup here is that, I'm not expecting it to really breach 30. I just wanted that protection in case it did. So my hope is that this thing, I get to buy it back, close it out early, and sell another call, and just keep doing that until I decide that I'm done with it, and then I just close the whole thing out. Best case scenario, I get a free long call. We can take a look at another one real quick here. We'll look at Baidu. So this is another one where kind of the premium is pretty high on the short term. So you kind of want to sell this short premium here in April. Take a 30. So we want to pick up, the $940 of this short premium here in Baidu for April. But you can see that this is going to give you risk to the upside, pretty big risk potentially. And, you're going to need $8,400 in margin when you start pushing up here into the strike, and, this thing's going to slide off. If I look at the probability here, so Baidu is a super expensive stock, 264. So to offset that by owning 100 shares, it's going to be expensive to buy 100 shares of that. So what we can do is we can kind of come out here to September and pick up one of these in the money options. And, we can pick that up for about $5,000 and we're going to offset it by about 900. And so you can see that, with just a little less than $5,000, you can get into this short premium trade with really no upside risk by selling that call. Versus if we were buying 100 shares, we're going to need upwards of $8,000 to $9,000 in margin to cover that trade. So, I mean, that's the poor man's covered call. I don't know if you've ever heard of that one before, Mike, but it's an interesting way to utilize your capital efficiency.
I have not. It is very interesting for sure.
So you can see here that from here, this one, 250 is in the money, not much in the money. It's about 264. But if this thing really starts to run, you're going to lose money out here. But, this thing's really tapering off. And so you're going to still make money no matter how this thing spikes up. But if we come out here and you sell something out of the money because, it's cheaper, now you run this risk where if you get a real big pop, you could potentially still lose money on the upside.
So is there a strategy to where you want to sell in the money as far as it relates to either the price level, the levels of the position, or is it just a financial fundamental at that point of, okay, this much in the money's $10,000, this much in the money's $6,000.
So I think you can really kind of, as long as you're looking at the P&L of the whole trade and you really understand the risk to the upside and the risk to the downside, I don't think it matters so much. Now, I have read a lot that you really want to be selling about a 70 delta in the money. So right here is your deltas. And so a 70 delta would be about a 230. I think that's a little bit deep in the money personally, because it almost makes, see how high this is? Like for me, I can save a little bit on what I'm buying because, I have a feeling that this thing's, it's probably not going to 440, 450. So kind of protecting yourself to that, doesn't make a ton of sense. So,
Nice.
You could come down to maybe a 250 and you still have about the same slope risk on the downside if this thing starts falling against you. But you can see how this is now coming down further out. So the one thing I will caution you on a poor man's covered call, and this might be a reason not to do a poor man's covered call. If the underlying has dividends, you're not going to get them. So with a covered call, if the stock that you have has dividends, as time passes and the ex-dividend dates go by, you own the stock, so you're collecting those dividends. In a poor man's covered call, you're not getting them. Now, I don't think Baidu has dividends, and I don't believe Rocket does either. So it's kind of not a thing. But if there were dividends, you should be advised that basically you won't get them with this strategy because you don't hold the shares. So, yep, that's poor man's covered call. We'll take one last look here at Rocket because we kind of focused a lot on the upside, but the downside, you still have this downside risk, and really your max loss is the amount that you've sold here. So $4,000 is my max loss because of the difference between my $6,000 that I paid and the $2,000 credit. But honestly, if this thing expires worthless, I'm going to sell another call and, collect more premium and just do it again and again and again until eventually it's really a free long call in the ideal situation.
Yeah. So that feels like another important point is that at no point are you ever unsure of your downside risk. Like you said, it's not like you still need to manage it, but it's known up front. So I paid $6,000 for this. I sold this for $2,000. So if I don't touch a thing, worst case, I'm out $4,000. Best case, obviously, I'm up. But still, from a portfolio management perspective, that's worth a lot to be like, okay, so worst case scenario, I'm out $4,000. Obviously, I'm going to just hedge that myself with this position on those short calls in the interim. But at the same time, maybe I could go hedge that somewhere else, and now now we're on the up and up all over the place. Like that finality is
for sure.
pretty
It's
attractive.
and that's the difference between the covered call, right? I mean, theoretically, the stocks that you have can go to zero. So your downside risk is, it could go to zero. It's not likely, but here, you got a downside risk is you're only out what you paid. So you that's in your realm of control.
Yeah.
All right. Well, I think that's about all that we wanted to cover in this week's episode. So we will sign off here. Just remind you guys all to check out the Discord room. If any of you guys have topics you want us to talk about in the section of the weekly show, we'd love to hear about them. Always looking for topics to discuss and kind of go over in more detail and how it relates to some of the trades that either I myself have done or perhaps Mike has done. So it was good chatting with you guys this week. And remember, think outside the block.